All right, let's dive right in. Gold and silver prices have been on an absolute tear. And if you're in the game, you're probably feeling a mix of thrilled and maybe a little nervous. So today, we're going to dig into a huge warning from history that every single person invested in precious metals needs to hear. Because what happened once, well, it could definitely happen again.
So this is the big question, isn't it? After such a massive run-up, history suggests a correction might be around the corner. But how bad could it really get? And is there a chance that, this time, things are actually different? Let's unpack the data and see what it tells us.
Okay, look at this. This slide is all about the pain and, more importantly, the patience. After that 1980 peak, if you bought gold at the very top, you had to wait 28 years, all the way to 2008, just to break even. And for silver investors, oh, it was even worse. A 32-year wait until 2011. This wasn't just a dip, you guys. This was a generational deep freeze for your money.
So, to really get a handle on the risk today, we've got to jump in the time machine and look back at what actually caused that brutal crash in the first place.
Think about this. Before that crash, gold went on one of the most incredible runs ever. It shot up 24 times, from just $35 an ounce to a peak of $850. It was a classic speculative bubble, you know? Everyone was losing faith in regular money. If that sounds a little familiar, well, it should. That massive climb is what set the stage for an equally massive, painful fall.
And here's the real kicker from the 80s. The big lesson isn't just that the price crashed. It's that investors who got in at the top saw their capital just stuck. It went nowhere for almost 3 decades. I mean, that's an entire career of just waiting to get your money back. That's the historical risk we have to be aware of.
Okay, so that's the scary history lesson. But what if this time is different? The argument today, especially when you look at silver, is that this isn't just about speculation anymore. It's a story about brand new, real-world, fundamental demand. And this chart, it lays it all out crystal clear. For the past 5 years, silver production, what we pull out of the ground, has been hovering around 800 million ounces a year. But demand has been consistently over 1 billion ounces. We're in a structural deficit. We are literally using more silver than we're mining, year after year after year.
So where is all this demand coming from? Well, it's not just folks like us buying coins. No. This is the stuff that's building our future. Every single electric vehicle, every solar panel, every smartphone, and now this crazy explosion in AI data centers, they all need physical silver to work. This is industrial demand on a scale that just didn't exist back in 1980. All right, so if the fundamentals look so strong, what's the catch? Where's the danger lurking? Well, it might not be in the price of gold or silver itself. The biggest risk, the one that most people completely overlook, is all about how you own it. Let's break it down into 4 main categories. At the safest end of the spectrum, you've got physical metal that you hold yourself. Pretty straightforward. Then there's allocated metal, where a big institution holds specific numbered bars for you. After that, it gets a lot riskier. Digital claims at a bank. But the real danger zone, the one we're going to focus on, is category 4, holding digital gold or silver using leverage, borrowed money, at a smaller online broker. This is the one. This is where people can get absolutely, completely wiped out, even if they're right about where the market is headed. And in the kind of crazy volatility like we saw back in the 80s, this trap is just waiting to snapshot. Let's break down exactly how that can happen. All right, let's talk about the leverage trap. Because this is where the rules of the game can suddenly change on you, right in the middle of a play. And you have to understand how it works before you get caught in it. So, what is leverage? Simply put, it's using borrowed money to control a much bigger position than you could with just your own cash. It's a double-edged sword, right? It juices your profits like crazy when you're right, but it absolutely magnifies your losses when you're wrong. A tiny price move against you can be enough to wipe out your entire investment. Poof, gone. I want you to think of the market like this. You've got the giant exchanges like COMEX. They're the elephants. When they get spooked, they change the rules to protect themselves. And when the elephants start moving, those changes roll downhill and just crush the ants. And the ants are the small brokers and ultimately people like you and me. So how do they crush you? Well, first, they can jack up your overnight borrowing fees, your swap fees, like triple them overnight. Suddenly it costs a fortune just to hold on. Second, they can demand more margin.
forcing you to dump more cash into your account right now, or they'll sell you out at a loss. And the scariest one? They can just suspend trading. You're trapped. You can't get out, but those fees just keep ticking up, bleeding you dry.
Look, here's the bottom line, and it's a direct quote that says it all. When you're trading on leverage, the broker who's on the losing side of your trade can suddenly make the rules. They can suspend you. You die. When you play in their house and your winning means they're losing, they can just change the game to make sure they survive. You're the one that gets squeezed.
Okay, that was pretty heavy. So if the real danger is getting caught in one of these traps during some insane volatility, how do you navigate it? How do you protect yourself? Well, there's a practical tool that can help you make smart, strategic moves instead of emotional ones.
A really simple way to think about it is like this. Gold is the stabilizer in your portfolio. It's your steady, reliable store of value. Silver, on the other hand, is the aggressor. It's way more volatile, which means it has the potential for much bigger gains, but also much bigger losses. Now, the gold to silver ratio, or GSR, just tells you how many ounces of silver it takes to buy 1 ounce of gold. And what's wild is that for centuries, literally centuries, it floated around 15 to 1. At the 1980 peak, it hit 17 to 1. But then look at 2020. It blew out to a staggering 125 to 1. Silver was incredibly cheap compared to gold. Recently, it's come way down. So why is this important? Because the GSR is like your compass. When that ratio is super high, it's a signal that silver might be undervalued compared to gold, and it could be a strategic time to favor silver. When the ratio gets really low, it might be time to rotate back into the stability of gold. It helps you make logical decisions instead of just chasing the price. So when you put all of this together, it really comes down to one big, powerful question. While everyone is obsessing over the price every day, the biggest threat to your money might be hiding in the fine print of your brokerage account. So the real takeaway is this. Go look. Go find out exactly how you own your assets and make damn sure you know the rules of the game you're playing.